So in this evening's live stream, we're going to look at the question of when are interest rates going to change? And I've used the word change rather than say fall, because of course they could still go up. But it's the start of the Easter weekend. It's the end of Q1 2024. I think it's a good chance or a good opportunity to zoom out, see what's happened over the last 3 months since we came back from Christmas, take a bit of stock about where we are on a big picture macroeconomic perspective, to get an idea about where we're going to go over the next quarter, indeed the next half, both with the economy and the UK property market. Okay, so that's what I want to do this evening. So as always, I've just realized I haven't got my comments on. As always, as we are live, please give me a thumbs up, give me a like, give me a comment to make sure we are live and you can hear me. I don't know if everybody's out enjoying the bank holiday already, although it's Thursday. It's a stormy Thursday. And if you're new to the live stream or new to the channel, welcome. In this channel, what I aim to do on these live streams is to go through objective data to try and make, or for us to try and understand what's actually going on beneath the bonnet of the headlines, mass media headlines and sentiment, and social media headlines and sentiment, to understand what's going on, to make better decisions and more informed choices, primarily in the investment space, but also if we're looking to buy, sell personal property. So welcome. If you haven't subscribed already, please subscribe to the channel. It really helps my mission here, which is to get the message of real analysis, real data to people who need to see it most. YouTube obviously likes to reward people who talk about doom and gloom, and that's not necessarily the right narrative that everybody needs to hear. So we're homing in on 4,000 subscribers. Please, I'd really appreciate it if you could give me a subscribe if you watch the channel regularly, if you're new, to hit that metric. And yes, before anybody asks, I have had a haircut, so thank you for that. Right, let's dive into the data and let's see. By the way, if you're on and watching this, please say hello so I know that we are here. Let's dive into it, team. Let's have a look at what's been going on. In fact, before that, let's just do a summary. Over the last, since December, in December, I said that the chances are that we're probably going to see a surge in sentiment as we come back after the Christmas period, for two main reasons. Number one is we've seen that, or we saw that drop in swap rates from sort of August last year, August 23, up to Christmas, quite a big drop in swap rates, which of course drove down average mortgage prices. The drop of mortgage prices are going to give people a bit more sort of headroom, combined with increased wages, and now in real-time wage increases, a bit more headroom, a bit more affordability to borrow more or afford more for their monthly mortgage payments, which may in turn feed into a soft landing or cushioning of the property market. And we also thought that was probably going to be counterbalanced a little bit by some sticky inflation. So I always said Q1, we're going to see some sticky inflation coming. Now, I would say both of these things manifested. So both of those predictions that we talked about have come true. What we have definitely seen this quarter is, without a doubt, that resurgence in I'm not going to say property prices, because that's BS, but resurgence in the house price indices, right? I'm not going to go in today about the legitimacy or the how accurate house price indices reflecting what's happening in the real world, but we cannot deny that the house price indices, and if we look, just do a quick flick through them, okay, we have seen Halifax. Let me just zoom in on that so you can see everything. In fact, I want this one. So we're seeing a increase in the Halifax HPI. We're seeing a increase in, if I find the right one, little tick up. Let's go to this one. That's probably a better one. Little tick up, sort of flatline tick up in the nationwide. If we look at the right move, we're seeing a trend up. So all of the HPIs are trending up. Now, the caveat to this is these are small data sets. We're still seeing a large, not reduction, but reduction on average years for the last 5 years of liquidity, right? So way lower housing transactions than we're used to. So this is definitely going to be skewing what these are, what these models are showing. We'll have a look at the Zoopla that just came out in a sec. The other thing that I want to sort of bring out in terms of confidence is we're now seeing, January has seen an uptick in GDP. Okay, so if we look at January 24, this is the January 24 report. We're following estimated to grow at 0.2%. which if we compare that to last year, it is confirmed, and we've just had out the first revision of last quarter, well, Q3 and Q4 from last year. No change in the revisions to GDP. So it is confirmed that technically we are now in recession. I don't know why I say the word technically, because it does frustrate me slightly, that word technically. We are in recession by the definition of the word. So we saw a positive in Q1, flatline Q2, negative in Q3, more negative in Q4. But the question always was going to be, does this continue down, or is this going to be temporary? So in January, we are 0.2% up, okay? Now, there's something that I want to pick out in this. So anecdotally, I'm just going to scroll down. I don't want to go too much into this detail. It's been out for a while. The one thing I want to talk about is the construction sector. So if we look at construction in January, and I just want to highlight this one here. The increase in monthly output in Jan 24 came from increases in both new work, 1.1%, and repair and maintenance, 1.2%. So it's this new work that I find quite interesting. So we've seen, I would say for the most of 2023, a slide in the construction industry, right? It was looking quite ugly. As I like to talk about, I have one of my businesses in the group is a scaffolding business. So we're kind of at the front line of construction. We're generally the second people in after the ground workers on new build sites. And without a doubt, H2, half 2 2023 was slow in terms of house building. Now, we're diversified in the scaffold business. So we service commercial, we service industrial, we service, sort of smaller things, repairs and maintenance, and we do new build sites. Without a doubt, the new build sites dried up. I would say that in January, the first week or two after Christmas was quiet, and then mid-January, boom. It was very obvious that new builders or new build developers or main contractors are back in business. I've had last week, I had to rapidly organize a finance product to go and buy a load more kit because we ran out of kit in the yard because we're on 3 new build sites, all timber frame new build sites, which eat a lot of kit. But 3 starting at once has just emptied our yard. And that's the first time in 2 years I've had to rapidly go and acquire a load more kit. And I think that shows, quite indicatively what's going on in construction. Now, will this continue is a question that I want to talk about. But without a doubt, house builders are back in business. My suspicion is that if you're breaking ground now, right, you're going to be basically building out over the spring and summer. So they're going to be out of the ground now, building out spring and summer, get everything, watertight to be finishing the fit outs over the autumn, winter. You're going to be hitting market probably end of this year, beginning of next year, when we could have seen the resumption. We could have seen a change in monetary policy. So we could go from QT back to, it's probably not QE, tightening to easing, right? Interest rates coming down, more confidence coming back in, more buyers coming into the market. So I'd imagine that's something that's going through house builders' minds. But if we look at this, it's a really interesting graph actually in construction. Here's the 100 line is you can see this. Basically, if we're below 100, it's contracting. If it's above 100, it's going up. You can see the repair and maintenance monthly index, how much that has spiked since COVID, which almost inevitably means there's been so much illiquidity in the market. A lot of people stuck in houses, they've been in for a while, and therefore repair and maintenance bills, people are having to spend money on repairs and maintenance that they wouldn't have done if they were moving house, if that makes sense. So I suspect that's why we're seeing this. But this is a real large increase. For the first time if I just zoom in on it, I shouldn't have done that. There we go. We can see the first uptick in what was, the last time we had an uptick was May 23, where we had a small uptick, but then it's been in decline since May 23. So an interesting one to keep our eyes on in terms of that particular sector. It's interesting because I think it's a good barometer of the health of the property market, that if the new builders are out there, if house builders are out there building, there's obviously some confidence come back in. So talking about confidence, I had a look at the UK consumer confidence measures to see where we are. March 2024. Again, hopefully you can see this. So in this, again, we've got an increase in confidence. So everything I want to say here is we are tempering that. I'm talking about trends. When I say an increase in confidence, it doesn't mean everybody's super confident. It means we're less unconfident than we were the last time. So the overall index is actually flatline. It's actually got slightly worse since January, but it's markedly better than this time last year. And the thing that actually is the first thing that stands out on this as a positive is the personal financial situation over the next 12 months is now having a positive reading on this. Okay, so personal finances, people are now net thinking their personal finances are going to improve over the next 12 months. And I think, when we talk about confidence, we talk about perception, and this is, will drive people's, sort of buying habits, spending habits. If you look at where it was this time last year, it's minus 21. This year it's plus 2. People do think the economic situation is still not looking pretty great with minus 23, but it's better than the minus 40 it was. And actually, it's slightly better than it was in February. Interestingly, this major purchase index see this year is getting worse. So January minus 20, minus 25, minus 27. So I think people feeling that things are getting better. They think their personal financial situation is getting better, but looks like holding off on making those larger purchases, which for me, I'm not exactly sure what quantifies as a major purchase index. I'd imagine houses, cars, things like that. So people are going, right, things are better, but let's sit tight for a little bit rather than spend all that money on everything. So another example of the trends reversing. Okay, let's have a look at what Zoopla says. This is Zoopla's March HPI, which came out 27th. So what's that? That is yesterday. This came out yesterday. So this is fairly hot on the press. The headline here, house price falls slow to negative 0.3% and the market activity improves with more sales, lower discounts and greater choice. Here's the latest on the UK property market. So let's look at the key figures. Yeah, fairly flat in terms of the actual house prices. So year on year, negative minus 0.3. Okay. So that's better than it was in October 23, which was negative minus 1.4. So this follows the other HPIs, the Rightmove, the Halifax, the Nationwide, saying that we're kind of looking to we've hit the lowest point of that negative year on year, and we're starting to come up. Zoopla is still saying we're in negative territory year on year. What it is highlighting here is that there's a clear divide across the country. So I know that we have a lot of people have discussions about how the house price indexes are flawed, and I agree with that. Something I always talk about is we have to look at not just regional, but I call them microscopes. I did a session on it on the last video. If you want to go back on the last video, have a look at that. Please do that. Talk about how, as a professional property investor, we have to look at street by street, not even region by region. So it's very obvious when we look at graphs like this that we have a big north-south divide, really, and we still got a huge amount of price pressure on the south. Interestingly, the east of England looks like the worst. London's, east of England the worst, then southeast. London is kind of faring better now. I think people are coming back into London. But looking at these sort of price rises in the north, so clear divide there. If we look at, I don't particularly care about this sort of stuff. Let's look at the percentages of demand versus sales. So we've got buyer demand has ticked up. Now, these figures, again, to put into context, are relative to this time last year. Okay, so it's the same period in 2023. Very often what Zoopla will do, will compare this to the rolling 5-year average. My suspicion is they like to cherry pick data a little bit to create a narrative. So if you remember, beginning of last year, to be fair, we did actually have a tick up after the mini budget, so we're out of that mini budget slump. Buyer demand's ticking up. Sales agreed is ticking up. Now, here's the interesting one for me. We do have quite a marked increase in flow of new supply, and I would say now a very marked interest in the stock of homes for sale. So what is clear to me here, right, is that the flow of supply is exceeding. We're seeing now a supply-demand imbalance. So even though we're not completely thawed, right, even though we're not seeing lots of forced sellers, we are definitely seeing an uptick in supply. Now, what are the reasons for this? Could it be people think now's the time to be selling? Could it be because they have to sell because we're seeing more people come off the cheap fixed rate debt? And this 2024 is probably the last year where we're seeing 7-figure plus people come off cheap fixed rate debt. So we're seeing a lot of people probably still with, they've been overpaying, over leveraged. We're now probably seeing people who were buying, at the peak of the market, coming off, what were we, 2024. So peak of the market are now coming off their fixed rate. So probably the people who bought right at the top are now coming off their 2-year fixed rates. And don't forget, people could have, bought deals or bought properties in 2022, early to mid 2022. It could have taken 6 months for that to go. They could have got mortgage deals locked in. It could have taken 6 months for that to go through. So maybe they started their mortgage deals, a bit later than that. So these people are now coming off their fixed rate and are probably going to be the worst affected in terms of affordability. So that would contribute to it. So we'll have to see what goes on with this, because as I said a couple of times this month, if we see an imbalance and more supply come onto demand, it's likely to exert downward pressure on house prices. So we've got, I do like Zoopla's data actually. 41% of sales agreed are at least 5% below asking price. So there's still a lot, this is what I mean, there's still a lot of price compression going back on, or price reductions going on. But it is talking, so there's a lot of them are 41% of sales agreed are at least 5%, but it says discounts on asking prices return to pre-pandemic average. Okay, so we can see last year, discount to asking prices. There we go for new sales. I didn't look at that. So we're not getting carried away here. I think Zoopla is very realistic in that it's pretty much probably agreeing with me, saying things that in a nominal term are probably going to stay pretty flat over the rest of this year. If anything, I think we could see a little drop down if we look at the ONS data, which of course is the relevant data. So I think that's of interest. What else have we got? Let's look at the other indicators that we're ending right now. Average wages, so wage growth, again, coming down, but still high. Real wage growth going up, right? So we are seeing that go up. So this period down here, I don't know if you can see my cursor, this is the bit where everybody got a lot poorer, right? I think it's important to to caveat that there was quite a spike before, so in between COVID, so kind of 2020 to to here, there was a spike of real wages going up. Then they went down, offset. Now they're going up again. I think we still are on average, if you look at real wages, down significantly over the last sort of 30 years or so, since the sort of 90s, but they're trending up. So that's going to give people more affordability. So a lot of the indicators are showing increased confidence, right? The indicators showing increased confidence, increased activity, and that's kind of across the board. What else are we seeing? Let's have a look at swap rates. Swap rates here, 5-year swaps currently 3.8. So a month ago it was 4. So the swaps have come down a little bit. We've got the gilts have come down again. So we were, sorry, I need to zoom out on that one. There we go. If you remember, they dropped down to about 3.5% with the market pricing in more aggressive drops or in interest rates. Crept back up. It was going back above 4, but it's come back down again. Again, it means the market thinking, okay, we're getting close to interest rates coming down. How does that reflect into mortgage rates? Well, after seeing the sort of trough in or the bottom of this sort of drop down in February, them creeping up again, they're starting now to come down again a little bit. So again, that's the market pricing in. We think we're getting to interest rate drops. Okay, so where does this leave us? The chatter at the moment, without a doubt, is going towards not if, but when are we going to see the first interest rate drop? The last that I saw was a very small prediction, sort of about 20% prediction of a drop in May. So we're not really expecting a drop in May, with a 50 to 55% market expectation drop in June this year. My gut feeling is that, I think probably June is even a little bit near. If I was a betting man, I would say it's going to be closer to August. And I think it's going to come down slower and take longer than even now people are thinking about. We do have these, there's a lot more people coming out now and saying we need to get this interest rate down because the economy is starting to creak. And, I agree with that, but it's not in a catastrophic sort of position at the moment. There's some, if I go over to the iPad and look at my news scrolling, I always like to get a vibe of the zeitgeist about what's going on. There was an interesting one, actually. So these are all in the last few days. So we've got articles on the Southeast, property bubble bursting. Another one, where is it? I can't see. There was another one I saw, maybe it's down here. There we go. Sorry. Yeah, another one. So multiple articles on Southeast and the home counties. We've got article here on delaying interest rate cuts will weaken the UK economy. So that's KPMG telling to the bank that they need to start bringing it down. We've got vaguely conflicting things with energy price cap experts now saying maybe it's not going to go down as much as we thought it would. So is that going to bring inflation? We've got other people saying inflation is going to come down. So Capital Economics have put a piece of research out saying they think inflation is going to come down way quicker again, and we're going to be below 2% for quite a long time, which means we're going to have to bring drops down. So there's a lot of narrative, a lot of analysts talking about we need drops, but we've still got high wage growth. We've got GDP little bit up in this month. We've got more confidence coming into the housing markets. There's still a lot of push-pull factors. For me, it's not a slam dunk, right? Rates are coming down because the economy is melting. There's still quite a lot of factors there that the bank are going to have to think about. I'm not saying they're not going to come down. I'm not for one moment saying it's like, oh, they're going to stay at 5.25% for the next 2 years or put it up. What I'm saying is it suddenly going to ramp down very quickly, or is it going to take longer? Interestingly, this was an article that caught my eye, which is why I put it in. Bank of England warns of private equity dangers. Just as an interest aside, because I'm about to talk about what will happen to interest rates and how will that affect the economy, and specifically the property market over the medium to long term, not the short term. In the era of cheap debt, it was very obvious a lot of people were borrowing, pretty much below inflation debt, free money with effect, and going out and buying private equity firms and small people, deal makers, entrepreneurs, property people, leveraging really highly to buy properties, to buy companies. And of course, when you have these assets, if you've got cheap debt, that's fine. But as soon as the cost of servicing that debt goes up, these things start to creep. So an interesting discussion here about private equity dangers with effectively this, private equity firms leveraging massive amounts of debt to go and buy these companies which are only living from the intravenous drip of basically free money. When that dries up, a lot of these companies, are going down the tube. So that's a worry with the economy. So these are the sort of things that I want to keep an eye on as the interest rates stay high over the next, next 3, 6, 9 months, the rest of 2024, and see where we go with that. Anyway, let's go back. Regreen says oil is going up. I had a quick look. So I think we're about, Brent's about $85 a barrel when I looked today. So it wasn't spiking massively, but it is definitely going up. So I do agree with that. If you remember, Bank of England have said that they foresee inflation coming down, going sub 2%, but then actually rising back up again as multiple things come into play. Don't forget, we're about to go into new financial year. We're about to see minimum wage go up. We're about to see a lot of young people have a much bigger pay packet. The question for me is, what happens with that? I think that's going to have a systemic ripple effect right into the economy. When I talk about what's going on versus perception, I think we need to be absolutely crystal clear here. A lot of stuff I'm talking about is perception. So perception of housing market recovery, perception of finances getting better. Are they actually, right? Perception is quite a fundamental factor that makes people have decisions. But if we start to see, another round of wage increases, if we start to see oil, come up again, as you said, if the price cap for the utilities doesn't go down as much as we thought, do all these feed in and have secondary inflation? It's a possibility. So remember, we always talk about the probability spectrum, and all probabilities have different possibilities. Other way around, all possibilities have their own probabilities. So we could see inflation come down, dip back up. Capital Economics think it's just going to go down and stay down. So we still have quite a split sort of room of analysts, if you like. Some saying, look, we need to get interest rates down now because the economy is about to melt down. Others saying, look, we're still high with wage growth. Inflation is still sticky. If you look at the core inflation, if you look at owner-occupier housing costs, housing market, rental incomes. So we've still got these factors. Why does any of this matter? I haven't talked about this report for a long time, so I'm going to end on talking about this. I love this report, and I've read it lots and lots and lots of times. I'm not going to go to the top of the report. I just want to go to the top of this chapter. So let me zoom in. This report is called Peaked Interest. It's by Resolution Foundation, who do I think some very interesting research. And effectively, this report talks about the long-term macroeconomic declining global interest rates over the last 40 years. So effectively since, beginning of the 80s, end of the 70s, beginning of the 80s, long-term macro decrease in interest rates, which has led to large passive increases in asset prices. Hopefully it should make sense that interest rates go down. A lot of assets like property, for example, will go up. So there's a whole generation, 40 years is a long time, and this is long-term macroeconomic trends. Of course, you're going to see variations in that. You're going to see variations, things like 2008 financial crisis. We saw interest rates come up beforehand and then crash down, right? But I'm not going to bore you with this long-term macro stuff. We've seen pretty much a generation of people benefit from the passive asset growth that this has caused. And 2021, end of, signified a change in that, a shift in that, right? And we've seen those interest rates change, fundamentally pivot. So I urge you to go and have a look at this report. It's anybody in property who's in property for the long term, I feel, should read this to get an understanding of how macroeconomics and interest rates on a global scale feed into things like asset prices. Because everybody out there likes to bang the drum of property prices are dictated by supply demand, right? It's like property prices are always going to shoot up because you've got loads of immigrants coming in, net million a year or something. We're looking at years in isolation when we talk about this sort of stuff. And don't get me wrong, supply demand, micro factors, environmental factors, regional factors, right? All these things go into the mix. But I believe that global big picture interest rates are going to be one of the major things that affects property prices. And we want to understand where this goes in the future. So the report here concludes talking about that future changes in wealth, i.e. asset prices. And we're talking very much about passive wealth here. Okay, so just buying something, it just goes up over time. It's going to be crucially where interest rates end up. And I've always said, short term, yes, we need to be wary of where the interest rates go, because it's going to force, if the interest rates last year had gone up to 6.5%, 7%, right? The economy would have melted down. A lot of people have been flushed out. Businesses would have been gone bust. Property investors and developers would be handing the keys back. It would have been a bloodbath, right? We never got past that tipping point. At 5.25%, we're pretty much, it's not a balanced interest rate. It's definitely putting strain on people, but it's not enough. It wasn't enough to put everything into meltdown for reasons we've talked about, over and over and over again. But this was always going to be a short-term increase. The question is, when it comes down, where does it go back down to? Okay, because if let's say we go into major economic meltdown and QE, the money print has to start again, and we go back down to sub 1%. Of course, that's going to take the brakes off everything, right? And those assets are going to start shooting back up again. But if it settles 3.5%, 4.5% as a central bank base rate, what does that do? I want to show you this graph. Well, first of all, I want to show you this graph. Now, this is we're slightly out of date now, but this is a user cost model that identifies periods of house price overvalue or undervalue based on house price to earnings ratio and a particular value. I'll let you read into it. We were reading fairly overvalued in terms of UK property market. At the end of 2023, we saw, obviously the last time we were up there was 2007. We saw sort of a large correction down. Actually, we saw a correction in terms of was property overvalued, undervalued from about 15. It carried on going down, right? Carried on going down to 20, basically until COVID. So I think that's really interesting. And, the property market was very languishing sort of 2017, 18, 19, down here. So that's interesting. And then, we went sort of overvalued. Anyway, what I wanted to show you was this graph here. So we got two diamonds here. The green, right, is where, let's talk about this. On the left-hand side, this is effectively house price to earnings. So it's a ratio of average price to properties to the average income in the UK. And you could see that, post-COVID, we were on the way up, right? So our average house price to earnings to house price ratio was going up. Depending where interest rates end up longer term, right? If we end up stabilizing around that 3.5%, 4.5%, this house price to earnings ratio is going to be significantly lower than it's been over the last sort of 20 years or so. If the interest rates continue to come down, sub 2%, even sub 1%, it could easily go up to, 10, 11 times, and property prices are going to literally, take off again. So for me, over the next 5, 10, 15 years, I would say the next property cycle, we're coming to the end of a cycle, as far as I'm concerned. We've seen that growth, we've seen the correction. Whether or not we're going to go into a capitulation or a further meltdown, I don't know. But whatever happens, whether it melts down or it doesn't, we're coming to the end of the cycle. And I always look at, sort of 15, 20 years as the next cycle. So for me, I've got one cycle left in me as a property investor. And understanding where this goes with interest rates defines what happens over the next cycle, defines the dynamics of the property market, defines how, as investors and property entrepreneurs, we make our money. I personally, I can't, unless the economy tanks, I cannot see interest rates coming back down to anywhere what they were. So when I mean central bank interest rates for the last 10, 15 years. That said, we'll probably have some, black swan event that tips everything over the edge. But for me, I feel they're going to settle higher. And if they settle higher, it's going to be a different property cycle to the last property cycle. Everybody, I would say, or pretty much everybody who is active in property right now has benefited from an era of ultra low interest rates and probably ultra high passive equity, passive asset gains. I think that's going to be different going forward. The next cycle, I think, is going to be defined by people having to be more active to force value appreciation. We're going to have to think harder. The whole sort of, there's a lot of talk about buy to let. I was running a Facebook ad campaign for about 3-4 months with the headline "Buy to Let is Dead," because actually that model of just going, somebody looking to replace their pension, taking cash, sticking it into a property or buying it with just buying a buy to let with a deposit and a mortgage, and hoping that it goes up over time, and in a lot of cases the rent doesn't even cover the mortgage. I think that way of investing is dying, right? I really do. I think it's very difficult to make money just using that sort of passive gain mentality with rent that covers the mortgage, especially with tax regimes and all that sort of stuff. For me, the real opportunity in property, if we're entering this era of higher interest rates, less passive gains, is a much more active value add strategy. But we have to be aware of that. So anybody who's looking at investing in property, or developing property, I think you need to understand what those strategies need to be over the next 5, 10, 15, 20 years, over the next cycle. That said, there is a case to be made that property is looking very cheap in terms of real terms. We have seen significant correction in real terms. So might we see a real time massive value increase in property over the next 15, 20 years, even if it's not nominal? That's an interesting thing that we'll wait and see. Cool. So look, that was just a quick. I say quick. That was not a quick wrap up. That was probably half an hour wrap up of Q1, and I wanted to go live this evening because I know we're going into long weekend. Everybody wants to be enjoying long weekend, friends, family, bit of downtime. And as we come back after Easter, we're going to start to see the next wave of HPIs, reports, releases to see where we are going into April. I suspect we will see flatline stagnation, maybe with a little bit of macro, reduction when you look at the averages in terms of house prices, even though the HPIs might not quite reflect that. So let's have a look at some of the questions. I hope that was useful to go through just as a thought process. What I'm going to do, I think just before I go to the questions, actually, this for me is one of the key graphs that I feel I've seen in the last 2 years. And understanding this graph and understanding where our interest rates go, I think is going to be such a key part of any property entrepreneur's toolkit or mindset process, thought process going forward on how you approach property. I know how I'm doing it. I'm very excited where we are at the moment. So to give you an idea, one of the reasons I've not been so active on YouTube over the last few months is I've got 3 acquisitions going through at the moment. All of them are interesting commercially valued style properties. So that doesn't mean they're commercial properties. I'm buying a block of flats. We've got a commercial property that is a commercial property that we're going to be looking to turn into a mixed use. And another commercial property is going to be a straight, sort of residential conversion, but very simple. These, there are some exciting opportunities, exciting deals to be able to buy things at great prices that are going to give great returns in terms of return on capital and cash flow. But what I'm definitely seeing is more people coming into, I would say at the moment, the more sort of, not resi. So the resi market is definitely very dead, but there's more people coming into the commercial investment space. And again, just to clarify, when I say commercial, I don't mean just offices or, retail. When I say commercial, I mean anything that has a commercial valuation attached to it. So there's so many different types of property. But we're seeing re-entry of people. House builders are starting again. The Chester property that I bought last year, that I think I did a case study on a couple of times, we actually had a tenant. So if anybody's new to this, I bought last year mixed use property, retail on the ground floor. It's actually a restaurant on the ground floor, 4 flats above. We have turned around, two of the flats are rented out. 2 of the flats we've given a refurb, and they're on the short-term let market, and they're booking up really well. We actually had a tenant lined up to go into the retail, but sadly the tenant pulled out just before we signed the lease, saying that they're just unsure over setting up a restaurant in current climate, current circumstances. That was actually a few months ago now, so that was kind of Christmas time, just after Christmas. When I think a lot of people are going, wait a minute, we're now, we're in recession. We're definitely in recession, and people have got a bit nervous, right? I feel that sentiment has changed. This week, we had a bidding war to get into that unit for us, and amazingly, we ended up with the deposit was paid today. Heads of terms were agreed this morning, and deposit was paid today, because that was my criteria. The rent offered was 20% above what we had it advertised at. So, basically had best and final offers and had to be an immediate deposit to secure it. And I think that, for me, when you look at what's going on shop floor, these things, house builders going, my scaffold yard being out of kit, having to go and put a finance package together to go and buy another 50 grand's worth of kit just to service a new build site. Bidding war, best and finals, and 20% above our advertised rent on a restaurant space. These things for me are showing a pivot in where we are right now. Could be a false dawn. If the interest rates stay high, we could see more. Well, we will see more creeks appear. A lot of people are saying there's damage being done now that doesn't need to be done, and the interest rates need to be come down. But I think when they're coming down, right, they're not coming down to sub 1%. We're talking about going down from 5.25 down to what, 4.5, 4, 3, 3.5, that sort of range. We'll see. Right, let's go to questions. So. Urban Achiever, how are you doing, Urban? I think, are you new to the channel? Gold has just broken through its previous high, like it did previously in 2000 and 2007 for Voting for the Economy. That's interesting. I've got to be honest, I'm not a up-to-date narrator on gold, but obviously it's a safe haven, right? And a hedge for bad stuff. So yes, that could be foreboding for the economy. Dan Cullen says, supply chain being severed during COVID and huge financial... Let me put these on, actually, put them on the broadcast. Let me just move that around. We don't want that. Let me just get that at the bottom rather than the top. And not cut off Dan. That's unfair of me to cut off your comment. I don't know why. I think somebody's been playing around my settings again. Let me just do it. There we go. That's better. Yeah, 50-year high inflation. Yeah, so there's been so much chat, right, about the inflation. Is it transitory? It's all third party. For me, I think it was third party events that caused that inflation, not internally generated inflation, which is why was putting interest rates up like we did the way to solve it, when that's not really the solution. All that's happened is interest rates going up, everybody else has put their price up, and it's actually created internal inflation. Let's be honest, we're not out of the woods with inflation. I did a piece when we looked at last month, when we actually look at what it costs people to live. The biggest things are food and shelter, and food and shelter, owner occupier housing cost is still going up in terms of inflation. So we're definitely not out of the woods yet. But there we go. Oh, Dan says inflation is over. I think it's interesting. Yeah, it's interesting. So by and large, I'd say rates. Yeah, Dan's saying rates on the way downwards. There you go. It's so interesting, isn't it? There's some. When I see some things, I go, yes, we're there, we're good. The utilities one was a big thing. So utilities obviously feeds into the supply chain everywhere. Is it over? Capital Economics reckons it's over. A lot of other commentators reckon we're still sticky on the core. So I think the next few months is going to be interesting. I think with my thoughts are we will see a rapid drop in inflation over the next quarter. So I always said it, Q1 sticky, Q2 we're going to see it come down a lot, barring any external external upsets. Main reason for that is when you look at the 12 months rolling data, right? We're going to see some big months of month on month rates fall out. Plus, we're seeing other costs come down. So I think we will see a rapid drop over the next quarter. The question is, does it come back up again? Do we see some secondary inflation? Do we see wage? Let's see what goes on with wage growth. Let's see what goes on with the economy. If everybody's starting to get a bit more confident, if everybody's out there buying again, is it going to cause secondary inflation? We'll see. The honest answer is I don't know. We're kind of guesstimating at this stage, but the trend at the moment is definitely down quite rapidly. I do agree with that. Oh, Dan, thank you for your comment about loving analysis. Urban, let's put this on urban, and then we'll tie off. I see many purpose-built student accommodation developments happening in West Midlands and London. Will this have a significant impact on general rental market, i.e. suppress rents? I've never thought about it like that, to be honest, Urban. So I see the student stuff being built everywhere. I think if anything, it'll probably do the opposite. My understanding is a lot of this purpose-built student accommodation goes to foreign students, right? Universities are businesses. Businesses want to attract, high fee payers. There's a lot of foreign students are not going to come over and live in traditional UK house of multiple occupancy, young one style. I don't know if anybody used to, watch the young ones. Young one style HMOs, which are, and these still exist, right? Damn horrible. So the universities put, quite a lot of time and effort into building these blocks. Private developers do the same. A lot of them, are actually, they're sold to investors. Will it suppress, markets? I see rental growth there's still such a lack of units out there, right? For me, it's one of the biggest issues we have at the moment is such a lack of rental stock on the private rental sector. Rental inflation has been so high. Look, I see it across, I feel kind of torn about this because on one side it's great as an investor with a portfolio. We've seen the rents come up, and I'm still lucky enough to be on a fair amount of fixed rate debt that we fixed 7 figures of debt at about 3% in 2021 for 5 years. So we've got that 2021, 2020. We've got it, I think, for another couple of years. So the rents have been going up and up and up. And I can't see that reversing anytime soon. I know some people said, rental increases have peaked in terms of rate of increase. They can't carry on going up, right? It's just ridiculous. But they have gone up significantly. So does the purpose-built student stuff, I can't see it suppressing demand. If anything, I don't think it will, is my answer to that. I don't know if that answers the question. It's not something I've thought about, but I like the question. So appreciate it. Cool. All right, team. Well, look, it's 8:15 on the first evening of a four-day bank holiday weekend. So we probably got better things to be doing than watching me rabbiting on about interest rates. My thoughts are we will come down, but I think we'll come down maybe a little bit later and a little bit more slowly than everybody thinks. The only thing that matters is not where we peak. It's not when they come down. It's where do they settle for the next 5, 10, 15 years. Of course, we can all come up with predictions and then something else might happen left field that we don't see about, right? And it all changes again. Sorry, another question from Dan. No worries at all, Dan. I will stay here as long as you want me to stay here. I don't mind. I don't have much of a life, so I lock myself down in this basement man cave and talk on YouTube, which is fun. So what's your thoughts on north versus south, best place to purchase a buy-to-let property? So great question, Dan. Let me start with giving my thoughts on what you should be looking at for an investment in the first place. So rather than, somebody's giving me a thumbs down for saying I've got no friends and locked myself in my man cave. I must not say that in the future. Negativity. I want to give you my thoughts on what you should be looking for in an investment, and that's return on capital employed. So return on capital employed is the return you get on your cash when you buy something, you add some value, recycle it out. Whatever you've got left in, right, that's your original capital. What really matters is the return you get on that cash. Okay, for me, that's the only thing that really matters as an investor. Gross yield, I don't care about. Net yield, I don't care about. Return on capital employed. If you want to get really smart about it, we can talk about IRR, which is internal rate of return, which is if you look at it over a set period, let's say 10, 15 years, what's the total return you're going to get on your money when you put in? The reason that I say this is because a lot of people think you have to go up north to get high yielding property, because of course, property is much cheaper. And the answer is you have to go up north to get gross high yielding property, but you can get high return on capital anywhere, as long as you can find places to add the value to, right? So if you're down south, right, and you buy something for $1 million and you spend $500,000 on it, so you're in for $1.5 million, it's valued at $2 million, and then you recycle and you get a mortgage for 75% and you pull that $1.5 million out, you've got none of your capital left in, right? Now, if you take a $1.5 million loan mortgage, you're going to be paying quite a lot of interest on it, especially with interest rates right now. So you have to make sure there's a huge amount of cash flow. So if that $1.5 million you put in was like, I don't know, let's say it's a block of service accommodation apartments, right? And it's pumping out 20, 30,000 pounds a month, right? And you're paying 15,000 pounds a month of the interest, and you're pocketing 10, 15 grand a month, and you've got no money in. Your return on your capital is infinite because you've got all your capital out. That's a bloody good cash flowing investment, right? Conversely, if you go up north and you buy something for 70 grand to stick your, all your cash in it, don't add any value. So you bought it for, let's keep the number simple. You buy it for 100 grand in cash and it pumps out, after cost, but you've got no interest. Let's say let's keep it simple, £500 a month, so £6,000 a year. You're getting 6% return on your money. So even though gross cash flowing, 6%, let's say 10 grand a year rent, right? So you're getting 10 grand a year gross yield, which also, if you bought it in cash, is a 10% return on your capital, right? You're getting 10% return on your money. So you've got a high gross yielding property up north, getting 10% return on your capital, versus down south, because you've been smart, you've added value, you've recycled, you're getting an infinite return on your money because you've got all your money back and you're still getting money over and above. So I hope that made sense, right? When I talk about investment, the Rocky figure is the only thing I care about. And you can get Rocky anywhere in the world, anywhere in the country, doesn't matter. Now, saying that, it's more difficult down south with higher property prices to achieve that. So it is easier to do it when you're in higher gross yielding areas to add value, recycle, okay? And to be able to cash flow. That's the big thing, to be able to cash flow, because to add value, recycle in high value areas, you're going to be pulling a lot more out, you're going to have a lot more debt, and with high interest rates, that's going to erode a lot of your net income. Okay, so I hope you're still with me so far. So I wouldn't let area necessarily direct you. The first thing I'll say is, what do you want to achieve? What are your goals? Are your goals cash flow? Are your goals return on capital? Are your goals equity add? Is it long-term wealth building? These are the first questions that I'll be asking. If you are in a high-paid job and you want to, build wealth equity, but you're not so fussed about cash flow for the next 20, 30 years, you're probably more likely to be wanting to do it down south. If you're looking for cash flow, if you want to get income, let's say you want to get out of a job, or you need to create an income, or you're borrowing other people's money and you need to get enough income to, pay them back and split it, then yes, I'll be looking Midlands and above. Personally, I live in Winchester, which is very much down south, and I invest in Chester, which is, I'm not going to say it's very much up north, it's north. So it's kind of the low part, it's the lowlands of the north of England, right, before we get further north. One of the reasons I do that, by the way, is because I've invested in Chester for 15 years since I lived there when I was in the Air Force, so I know the area very well, and I don't want to learn new areas. But my strategy is very much to go for higher value, higher quality, higher return on capital employed properties in Chester and the Chester areas, rather than I could go 5-10 miles out of Chester and get property that's 30% of the price based on a price per square foot basis. But I don't particularly want to do that, because you get more issues, you get more tenant issues, you get more damages. Residential property tax regimes are less favorable. So I like more interesting, I call them property unicorns, higher density units, blocks of flats, mixed use buildings where we can arbitrage things like price per square foot. We can arbitrage change of use. We can do things like yield compression. So I'm actually, I'm literally writing a book on this at the moment called Property Unicorns, which hopefully will get out finished in the next couple of weeks, and then it's going to go through the publishing thing. So hopefully launching it in end of April, beginning of May. I'd like to be launching that. But I talk through all the strategies of how you can leverage these different strategies that are different to just buy to let, right, or development or refurbs, to manipulate properties in a way that creates that return on capital employed for you by adding value, getting momentum, getting cash flow. So I don't know if that answers your question, Dan. The big answer is depends on your goals, depends on what you're trying to achieve. Without a doubt, to get high yielding stuff, is it easier to do it up north? 100%. So that's probably the first place you'd be looking, but I don't know enough about the context, Dan. So always happy to have a chat. By the way, if you ever want to have a strategy call on this, there's a link in the description to the video. Every video, complimentary, free, 45-minute strategy call. If you're looking at how to get started or grow a property business, book in, we'll have a chat. It's all cool. And then we can talk about how we can help you do that. Lovely. All right, team. Hopefully that was useful. Give me a quick thumbs up if that was useful. YouTube loves it. Come on. Please, if you're still here, hit subscribe if you're not subscribed already. I can see we've got over 50 people on the stream, and we're almost an hour into it, so must be something worth listening to. If you're not subscribed already, please, I'd love it if you could do me this one favor. It's the only thing that I ever ask for on the channel is hit subscribe. It's the biggest metric that YouTube looks for to give more reach. If we have more reach, we can get these messages, get this research. I like to think I present an objective, data-driven approach that actually helps people invest. Not the doom scrolling, not the doom mongering, not the everything's going to go to the moon. Some actual objective, sort of data analysis that helps people in real time, rather than just attracts people for the sake of getting views on YouTube to get ad spend, right? So if you could do that one thing for me, I would be eternally grateful. Otherwise, Dan, you're very welcome. Glad that was some good advice. Have a great weekend, everybody. I'll see you next week.